We'll be using the sample daycare example to review both transaction analysis and the preparation of simple financial statements. You should have a couple of handouts in front of you to follow along. The first one is this trial balance that basically has the transactions we'll be studying at the bottom of it. And then in addition, you should have just a printout of a Excel template, basically, where we will be recording each and every transaction in the life of the sample daycare company for a brief period of time, and then using this accumulated financial information to prepare financial statements. Now, for the most part, in this course, we will not be using formal procedural terminology. So effectively, we will only use the terms debit and credit when we're trying to clarify whether an account is increasing or decreasing. We'll do most of our analysis and have most of our discussions using the terms increase and decrease instead of the terms debit and credit. But you see a little notation here in this box that's not on your handout, but up here in the corner of the screen. And I just want to remind you that this is a very simple memory jogger for what debit and credits actually mean. So what I have written here, of course, is the accounting equation. The assets of a company will equal the grand total of the liabilities and equity of that company. Writing debit and credit on the left and right hand side of the equation is your reminder that the normal balance of asset accounts is a debit balance, and assets are increased with a debit. The normal balance of liability and equity accounts is a credit. Liabilities and equity accounts are increased with a credit. So this is the increase rule. It is the normal balance rule, and it's a reminder that in trial balances, T accounts, debits are on the left, credits are on the right. So for those times when we are using debit and credit terminology, and again, we'll only do that when we have contra accounts involved, and sometimes it really helps just to clarify exactly what an account balance is, to use the term debit and credit instead of talking about an increase or a decrease or a positive or a negative asset or liability account. But if we're ever using that terminology during class, if you just remember to write out the accounting equation and write debits equals credits above it, this will be a good memory jogger that you can refer to while you're doing that work. We do see the use of those terms here in the information that's supplied to us to do the sample daycare problem. What you're looking at on this problem page is a trial balance for sample daycare as of the end of the most recent year. So this is a trial balance for the year ended December 31st, year 2. And we see debits here on the left and credits on the right. Now, a trial balance is basically just a listing of all of the accounts that a company has in its general ledger and a statement of the balance in that account at the end of the year. If the account has a debit balance at the end of the year, we list the balance here on the debit side. If the account has a credit balance at the end of the year, we list it over here. We know that assets normally have debit balances, so if account balances are provided to you in a trial balance format, then you can use the fact that there's a debit or a credit balance in each account to help you actually determine whether it's likely that account is an asset versus a liability versus an equity account. We wouldn't have to present the information in this way. I could have just given you a list of all of these account titles and told you what the balance was in the account at the end of the year, and you'd have been able to use the information the same way. Just as we know the accounting equation has to balance, the grand total of all the assets has to equal the grand total of all the liabilities and equity, we also know in a general ledger accounting system, the grand total of all the debits has to equal the grand total of all the credits. And by the way, these aren't assets and liabilities and equity. This is just total debits and total credits. So let's take a quick look at the various accounts that are involved here. Basically, we'll be doing the accounting for Sample Daycare for year 3, and we're going to do some of it in a real summarized form. Just to save time, we're just trying to get the basics across here. But we'll be doing accounting for the next year, the accounting period that follows December 31st, year 2. Sample Daycare will have an annual accounting period in this problem. And that's important information for you to keep in mind, because whether or not we record costs as an asset or an expense oftentimes depends on what the accounting period is. And the same holds true for whether or not we record amounts received as unearned revenue or as revenue. To make our decision and to appropriately use any kind of rule of thumb, we have to keep in mind what the accounting period is. So we'll see some examples of that in a little bit. Here what we do see is that cash, accounts receivable, prepaid rent, office supplies, and the furniture account, all at the top here, have debit balances. Hopefully you also recognize that these account titles generally represent what we would call assets in financial accounting. Recall that assets are the resources of a business. Assets are expected to provide benefit to the company beyond the end of the current accounting period. So all of these things are expected to provide benefit to Sample Daycare beyond the end of year 2. Now there's one more account here that actually is listed with assets, but it doesn't have a normal debit balance. That's the accumulated depreciation account. Recall that accumulated depreciation is a contra asset account. It's a negative asset. So this account is listed as an asset, but it's a negative asset, so its normal balance is not a debit, it's a credit instead. So that's why the total of the debit column is not necessarily going to be total assets, because every once in a while we'll have contra accounts, accounts that get listed in one part or the other of the balance sheet, but they have the opposite of a normal balance. So these accounts right up here represent our assets for Sample Daycare as of the end of year 2. On the credit side, we see accounts payable. That would be our only liability account. And we know liabilities normally have a credit balance. So this is a positive liability. Sample Daycare owes $14,300 on account to vendors, possibly. That would be the most likely thing. We have a few placeholders for some other liability accounts. And then down here we have 2 very basic shareholders' equity accounts for a corporation. Common stock, which represents the money that the owners put in, and retained earnings. Retained earnings represents all of the earnings of Sample Daycare over its entire life, minus all of the dividends distributed to shareholders over its entire life. So, by just looking at this balance, we see it's a $5,800 credit balance. Because it's a credit balance, it's positive retained earnings. What that tells us is that Sample Daycare has had at least income, net income, of $5,800 over its life so far. They may have had much more income than that, and they may have distributed some of their income out to the shareholders in the form of dividends. So maybe, for example, if Sample Daycare has been in business for 2 years, they've actually had accumulated earnings between year 1 and year 2 of $105,800, and they distributed $100,000 of that profit to the shareholders in the form of dividends. That would leave $5,800 in retained earnings. Think about it this way. Retained earnings represents the accumulated profits or net income of the business that have been retained inside the business as opposed to distributed out to shareholders. We have the dividends account here. The dividends account is once again it has a zero balance at this point because the dividends account is going to be used to accumulate information about dividends that get distributed during year 3. The other account titles that we see down here are our revenue and expense account titles. We only have one revenue account for sample daycare revenue, and we have a variety of different expense accounts. These account balances are all zero because these are temporary accounts. These accounts start every year out with a zero balance, and they reflect only the revenues and expenses for a particular accounting period. So we'll be doing the accounting for year 3. These accounts have all been closed out, and the balances in these temporary accounts, dividends through interest expense, have all been moved into the retained earnings account. Now, all of that is part of the more formal accounting process that you've seen previously. In this problem, we will actually take the simpler approach where we will show the recording of these temporary accounts, dividends, revenues, and expense accounts. We'll record transactions in all of these accounts directly into the retained earnings account. That, of course, is a simplification. That's not the way companies actually do it, but it represents where the balances in these accounts will end up after a closing entry process anyway. So we'll follow a very simple accounting equation format for recording transactions in this problem. We will end up in the same place that we would have ended up if we had recorded transactions in journal entries, posted them to a general ledger, and followed the whole formal accounting process. Well, right now, why don't you also pull out your printed copy of the spreadsheet where we will be doing the transaction analysis for the sample daycare company. And the first line up here, that's an abbreviation for beginning balance. There's a place to put the beginning balance in all of these accounts. So use the trial balance and fill in the beginning balance in each one of these accounts going across. I've abbreviated a little bit, but you should be able to figure out what they are. So take a moment and do that. The spreadsheet, of course, is set up so that we can do our transaction analysis in accounting equation format, a highly simplified version of accounting, but really one you could use for any company. So the accounts with the yellow background here, cash through accumulated depreciation, these are all of our asset accounts. So you could right above here, right above this line, write assets, because those are all of the asset accounts. Then over here on the other side of your spreadsheet, accounts payable, unearned revenue, this is interest payable and note payable. These will be our liability accounts. So above these 4 accounts, you can write the word liabilities. Again, common stock and retained earnings are our equity accounts. So what you really could do is above your asset accounts right here, I would make this a bold line. Right above this line, you could put an equal sign, because we're basically going to show that the sum of all the asset accounts throughout our process will be equal to liabilities plus, you could put a plus sign here, the equity accounts. So basically you're writing above these account titles A equals L plus E. And these account titles are just the underlying detail, the content holder, so that we can prepare useful financial statements. Off to the right of retained earnings, I've got an extra column with detail. The detail is where we will put information about every account that we record in retained earnings. Because remember, what's going into retained earnings is all of the revenue, everything that would hit any revenue account in a more formal accounting system, we're going to put into retained earnings in our simplified accounting system. Expenses reduce retained earnings. So when we record an expense, instead of putting it in an expense account, we'll reduce retained earnings. Dividends reduce retained earnings. Instead of putting dividends in the dividends account, we'll actually record it here in retained earnings as a reduction. However, in a formal accounting system, remember, there would actually be separate revenue accounts, expense accounts, and generally a dividend account. All right, well, hopefully you've had a chance to put the beginning balances in here, and these numbers come straight from that trial balance. These are all of the accounts that we said were asset accounts, and so these numbers came straight from the trial balance. There was a zero balance in daycare supplies. That's what that stands for. And remember, accumulated depreciation is a contra or negative asset account. It had a normal credit balance of $3,200. We would call that a positive balance in the accumulated depreciation account, but since that account is a negative asset, here in the equation, it's a minus 3,200. The 3,200 represents the total amount of the cost of the furniture that's been written off to depreciation expense over time. These two accounts are buddies. This account offsets the furniture account when we go to prepare a balance sheet. On the other side of the equation here, we had accounts payable, we had zero balances in these other liability accounts, we had common stock and retained earnings. If you do a quick check, I'm in Excel here so I can do it easily. The sum of all the asset accounts is $24,100, and the sum of all the liabilities plus the equity accounts is also $24,100. So we know our accounting system is in balance. The accounting equation balances across the equal sign. Now, as we start to record transaction analysis, remember that the accounting equation has to stay in balance. So each and every transaction also must balance across the equal sign. We put this bold line here because that's where the equal sign is. You can eyeball each and every transaction you record and make sure that you have a balanced effect across this bold line as you record those transactions. As long as each and every transaction balances in the equation, our totals at the end of all of our analysis will be in balance just like our totals were at the beginning. All right, let's go ahead and get started. Take a look at the notes right underneath the trial balance on the initial problem page. Notice that we'll be recording 10 transactions for sample daycare. And, you know, if we were all in the classroom together and we were all recording these transactions independently, there's a very good chance that we would take different approaches on some of them. That's okay. We'll talk about that when we get to those transactions. Here I'll demonstrate our basic rules of thumb, and I'll do one sort of the opposite way that we've been talking about in the past, and show you that companies can actually use different rules of thumb, and as long as their adjusting entries take into account the way they recorded the original entry, then we can always come up with one adjusting entry that fixes everything. And it really doesn't matter how you record the initial transaction as long as you do the appropriate adjusting entry to correct balances before anybody sees the financial statements. All right, so we'll be recording 10 transactions. 1, 3, 4, 5, 8, 9, and 10 are transactions that just happened during the year, and we're just sort of recording them in summary form. So for example, you'll see this first transaction, the daycare provides $50,000 worth of services. Well, that doesn't happen all in one day. They do that throughout the year, but I don't want to record 300 entries for this. So we're just going to record one summary entry to reflect all of these service type transactions. There are a few, and there's other entries that are similar here. There's also a few where I want us to pretend instead that we're actually recording the entry on the date given here. So we'll record entry number 2 as if it is April 1st. We'll record entry 6 as if it is August 12th, and entry 7 as if it is November 1st. So after recording our transactions, we'll come up with our unadjusted balances in all of these accounts, and that'll be easy to do because we're just doing it in a spreadsheet approach. And then we'll go in and think about what we need to do for adjusting entries given the style in which we recorded these transactions. The best way to do this, I would think, for you is try to do this now ahead of me, or go transaction by transaction, but just before we get to a transaction together, pause the video and try to do it on your own so that you can determine where you've got questions and get your questions answered as we go along here.